Thank you all very much for joining us this morning. My name is Steve McMenamin from Indian Harbor, and I'll be the warm-up moderator for today's event, which is part of the ongoing series of the Greenwich Roundtable. I believe this is our 7th year of doing this here at the Bruce Museum. I'd like to thank John Snyder and Bill Johnson, sitting to my right of Paloma Partners, for sponsoring today's event. John, would you like to say anything? Okay. Well, thank you.
I would just say we'd like to thank Steve and the Greenwich Roundtable for hosting this, having us here as hosts today. And if you would like information on Paloma Partners, please feel free to look for me after this event. I'll be here afterwards, and I'd be glad to speak with you.
And it will live on in a webcast much more longer than we're doing today. I'd also like to thank the Bruce Museum for sponsoring the venue in which we sit today and the wonderful works of art that we see staring down on us. Our topic this morning, Best Practices in the Management of Risk, is one of my favorites. On January 23rd, 1997, we first explored this topic, which was a more qualitative discussion on this often overlooked discipline. At that time, some of you who know me, I'm an ice climber, and we were coming back from the Uncompahgre Gorge, say that 3 times, where we were climbing and really examining. If you have ever spoken with or known a climber, there are 2 kinds of risk in climbing. One is subjective risk, which is the risk of pilot error or climber's error. The other risk is the objective risk, the risk that when you're climbing, the surface in which you're climbing all of a sudden falls out from underneath you for whatever reason. Climbers have a very, very fine-tuned sense of risk, and from that, our first discussion started on the management of risk. 5 years later, we're here today. But at this point, I'd like to introduce our speakers. Sitting to my left, Jim Vinci will lead today's discussion. Jim is from Paloma Partners. Jim is the Managing Director and Chief Risk Officer for Paloma Partners, overseeing all aspects of their risk management activities. Prior to Paloma, Jim worked at PricewaterhouseCoopers, where he was co-head of the Financial Risk Management Consulting practice and globally responsible for credit risk management consulting services. Before PricewaterhouseCoopers, Jim was with Lehman Brothers for 10 years, where he became global head of market and credit risk management for that investment bank. Jim is a certified public accountant. He is a member of the advisory board of the Carnegie Mellon Masters in Computational Finance program and is a member of the prestigious Q Group. Sitting to Jim's left is Sudhir Krishnamurthy. Sudhir is the managing director of Carlyle Asset Management Group's hedge fund of funds, joining that group in the early part of this year. Before Carlyle, Dr. Krishnamurthy was the director of World Bank's Investment Management Department, where he was responsible for managing $12 billion in assets for that pension fund in equities, fixed income, and to our group's interest, alternative assets. Prior to working in the pension fund, Dr. Krishnamurthy was the director of corporate finance at the World Bank, where he managed $27 billion of equity for the World Bank Group. Prior to the World Bank, Dr. Krishnamurthy was an assistant professor at the Sloan School of Management at the Massachusetts Institute of Technology. He received his doctorate from the Harvard Business School. Sitting to Sudhir's left is Andrew Lowe. Andrew is the founder and chief scientific officer of the Alpha Simplex Group, a quantitative fund backed by Paloma Partners. Andrew Lowe is also the Harris & Harris Group Professor of Finance at the Massachusetts Institute of Technology, Sloan School of Management, and the director of MIT's Laboratory of Financial Engineering. Professor Lowe is extensively published on, among other titles, The Econometrics of Financial Markets, A Non-Random Walk Down Wall Street. His awards include the Alfred P. Sloan Foundation Fellowship, the Paul A. Samuelson Award, the American Association for Individuals and Investors Award, and the Graham and Dodd Award. Hopefully today, Professor Lowe will give us a layperson's understanding of these subjects that are in his research realm, which include financial engineering and risk management, trading technology and micro-market infrastructure, financial visualization, and the evolutionary and neurobiological models of individual risk preferences. So with that, I'll turn it over to Jim to frame today's discussion.
Thank you, Steve. I'd like to thank everyone for taking out the time from their busy schedule to come to the roundtable. And as Steve mentioned, when you have a conference in 1997 and the issue of risk management has been around, we've been talking about it for the greater part of 10 years or so in conferences such as this, you could ask the question of why is it that risk management still attracts such a large following at a roundtable? Why is it that we still have, in essence, so much uncertainty as to what the best practice in risk management is? The so-called bid and offer, the bid and ask between good practice, best practice, continues to be quite wide. A personal opinion is that as trading becomes more complex and the taking of risk becomes more complex, traders are going after more and more single focused slivers of risk, and therefore the risk management practice becomes much more difficult. We have to understand that sliver of risk that is being taken in the world by the trading group. If the risk is so small and that aspect is being leveraged, it's important for the risk manager to be able to understand that particular aspect of the risk. Risk management will continue to evolve. The bid and offer in risk management will, in essence, never really close. As we started to discuss the roundtable and the topics for today, I think one thing that became apparent to Steve and the panelists here was that when thinking about risk management, it was important to understand which vantage point you were looking at it, the risk management of. We thought about it and we said, well, it could be very simple. You have two aspects. You have the ultimate risk taker and the ultimate risk investor. And you would think that there's only 2 points of view to look at risk management from. But in a complex world where you have multiple layers of decision making and multiple layers of investment decisions in terms of capital allocation, it's not as simple as just who the investor is and who the risk taker is. So we thought about the way to frame this panel would be to frame it from 3 different points of view. And each of us will try to speak about one particular point of view. Sudhir will speak first about the point of view from the fund of funds, or in essence, the investor point of view, based on his experience at the World Bank and at the Carlyle Group. I'll then speak more towards the risk management best practice, focusing on it from a multi-strategy, multiple asset class risk management point of view. And then Andrew will enter more of an enterprise-wide risk management view from myself. And then Andrew will speak to risk management as a fund manager, actually, more granular at the risk-taking level. And so we thought that by covering that spectrum, we'd be able to give you an interesting view of risk management across the different aspects. So with that, I would turn over to Sudhir, who will start first at the investor level.
Thank you very much, Jim. Thank you very much, Steve. And thank you all very much for having me here this morning. My remarks, as has been pointed out, is going to be from the perspective of a typical plan sponsor investing in alternative investments, be it alternative investments, be it hedge funds in particular. And so to that extent, it will be perhaps at somewhere about the 15,000 feet, and I think the others in the panel will bring you down more to earth as we go through the discussion this morning. Why have pension plans started looking at alternatives? I mean, that would be the first question that I would pose. And what has happened is the change in return expectations, that is from what you can expect from public markets. What people are now expecting out there, the investment managers, has been brutal. I mean, the reductions in return expectations have been very, very significant. On the other hand, if you look at how large pension plans, and for that matter endowments to a certain extent, value their liabilities. The liabilities, especially for pension plan, the discount rate, if you do even an anecdotal survey, you'll find that we are talking about discount rates of somewhere between 9-10%. And those are returns which are very unlikely to be met by pension plans. So the question is, there is that search for alpha, there is that endeavor to see how can we get more alpha from the investments that we have. And so investment managers have been looking outside their traditional realm. They've been looking outside the typical equity, bond, cash, and voila, you have the entrance of the alternative investment asset class. And this is true across the board. It's true. It is true where I used to work at the World Bank. It was the search for alpha which got us to alternatives, and I'm sure many of us sitting around this room today thinking about alternatives are already in alternative investments for very much the same reasons. Some of us, I'm sure there are some around this room who are really far-sighted, who, in fact, there are some endowments who got into the alternative asset class many years ago. But for most people, alternatives as an asset class or as an investment opportunity really started getting going only around the mid-90s, I would say. And that too, in a small way, people got their feet wet. But many people are still looking at alternatives, and I'm sure there are some around this room who are still thinking, is the hedge funds the asset class that I would like to be in? Which then begs the question, how much should one invest in alternatives? How much should one invest in the different parts of alternatives? That is, if I treat alternatives as one asset class, which includes hedge funds, private equity, real estate, I lump them all together in alternatives. And the only reason I call them all alternatives is because they tend to be relatively illiquid relative to the more public market securities. How much should one invest in each of these individual subsectors? And finally, and I think the most important question, which is where I'd like to spend a little more time this morning, how do we actually go about, what do we need to get in order? What are the things, what are the housekeeping things that we need to put together before we start making investments in these asset classes? And that's really where risk management comes together. As I said, if there are three questions, how much should we put in alternatives, how much should I put into the different subsectors, and finally, how should I go about doing it? The first two are really asset allocation questions, and so I'm sure I find the subject fascinating. I hope you do too. But that will be going away a little bit from the topic at hand today. So I'll be relatively brief. I think it's important because at the end of the day, it is the asset allocation decision which poses the greatest amount of risk, in my opinion. But I'll try to be narrower in scope and leave the asset allocation discussion for a later day and restrict most of my remarks at least to the third question, which is how should what are the parameters that one needs to put together before one starts getting into investing in these asset classes. And as I speak about how we get into this, it is very important to realize, and I realized this even as we started getting into the alternatives area in the mid-90s, that people say you're talking. There may be those around in this room who will say, we thought this was a panel discussion on risk management, and you're going to tell us how you go about investing in hedge funds or something like that. They're really the same issue. They're the different sides of the same coin. You cannot have investing without risk management. They are totally tied in together, and I think when I talk about investing and risk management, it will be almost in the same breath. As I said, let me dispose of the first two questions briefly. how should one think about putting money to work in the alternatives area, and how should one decide how much money in each of the asset classes, sub-asset classes, if one can call it that. First of all, there might be some around this room who don't believe alternatives is an asset class itself, but we will leave that for a more for a debate over drinks, maybe.
Well, I think you've got a lot of believers here.
Oh, you've got believers. Okay. No, whether it's an asset class is a question. I'm not sure people I'm sure people believe that it's worth investing in. Whether it's an asset class is the question, but we'll leave that aside. At the end of the day, determining what fraction of your assets should be in alternatives. The asset allocation decision, you can have a lot of quantitative stuff, and people who have come from MIT tend to be just a little bit more quantitative, and as Andrew on my left will say, you get the last number right. And so asset allocation is a little bit like that, and you can do a lot of quantitative stuff. And we have done, I've done my share of quantitative work in the area as well. But at the end of the day, it is a qualitative decision. It is you have to do it in a qualitative sort of way. It's a little bit of an art, a little bit of a science. But the important thing to remember in the alternatives area, especially when you have to decide how you want to do it, the typical mean variance approach falters. It fails. And there are a number of reasons. The mean variance approach works reasonably well in things like when you're talking about public securities, equities, bonds, cash. It completely fails us when we start thinking about alternatives asset classes. And there are three main reasons. You have problems on valuation. You have problems of illiquidity. And I think the third and very important one is what I call tail risk, which is the fat tails of the distribution, which are very typical in alternatives and less so in the other asset classes. Whereas if you take a typical public security and look at monthly returns, you will find that they are fairly Gaussian, normally distributed. Less so if you look at some of the alternative asset classes. So how does then one do it? There are quantitative methods, and we can spend a lot of time this morning talking about how you can do factor analysis of those returns. Then you can take factor loadings, and in fact I have in my notes, you then do volatilities, and then you find correlations, and then you build a variance covariance matrix based upon all of that. And people have done all that, and people have in fact then even for illiquidity, you make certain assumptions on what kind of premiums you assume for illiquidity, and based upon all of that, have the return expectations for these asset classes. They have a volatility and a variance covariance matrix for alternatives that you can build up from ground up, and not just taking returns, but more sophisticated methods, and come out with allocation, which are okay, but they still don't take care of what I think is one of the more important risks in alternatives, which is the fat tail risk, which is the tail risk, which is you have the possibility of very extreme events happening in these alternative asset classes. And the main problem with that is if you take if you want to crack the nut of tail risk, volatility unfortunately is not a good risk measure, and that's the fundamental problem. In fact, if there are, I do not know how people around the room look very young, but for some of us who are perhaps just a little been there just a little longer, if you were to read the original Markowitz, what Markowitz had to write, he himself realized that volatility is not necessarily the best measure of risk. In fact, he was going in the direction of semi-variance. I would argue that even drawdown, for example, the maximum drawdown and things like that, are perhaps much better measures of risk than typical volatility. But the problem is, if you take typical drawdown as a measure of risk, then why, if Markowitz realized volatility is not a good measure, why did he use, or why do we all sit around and talk about mean variance and standard deviation as a risk measure? And I think the main reason is, and here I noted it down because I didn't know whether I'd remember this. It's called deterministic combinatorial optimization methods. The long and short of it is, if you use variance or volatility, it's much more easy to use it in putting together portfolios. It's much well behaved. It's well behaved as a statistic, and therefore you can quantify it and you can put things together. You use drawdowns, you can't, and that's the basic problem. Suppose you have, if you use drawdown as a risk measure and you use expected return as return and drawdown as the two statistics, you can't combine them together in an efficient frontier. The frontier is not, you don't get a smooth frontier like you would in a mean variance approach. So, for example, if I were to go back to you and say, this is the total amount of drawdown that I would like to have, or this is the maximum capital loss that I would like to have. What is the maximum expected return? Construct a portfolio from me from a set of alternative assets that will give me the maximum expected return. Non-trivial problems to solve. It is not so straightforward. You will necessarily need to, because as I say, the surface is jagged, and you'll have to do what they call use search methods. It tends to be more heuristic. There are no closed form solutions. It has to be heuristic. It's a search mechanism, and you have to make sure you get global optimums. And we have been looking at various things. People try to take tools which have been developed in one area and use it in finance. That's the typical mode. Black-Scholes, they went where they went and where they got the tools from. So we started looking around, and people have started working on genetics and used genetic algorithms as a mechanism for solving heuristic problems of this sort. So anyway, cutting to the chase. We did all this, you do all this, you do genetic algorithms, you can do whatever it is. At the end of it, most institutions come up with a magic number of 20%. And at the end of the day, it's a question of how much illiquidity are you willing to take in your portfolio. And people eventually, pension plans, endowments tend to be much higher. Most pension plans do not like highly illiquid assets in their portfolio. So 20% seems to be a round magic number over the surveys that I've seen. And it's not a number which is very different from what you would get from quantitative analysis, I'd hasten to add. So I wouldn't poo-poo quantitative analysis completely. But most people, what they do is they start off with a much smaller allocation. People who have not been in the alternatives area, have not spent a lot of time, start small, grow the portfolio. And at the end of the day, you need to be comfortable. Because I'm sure all of you have oversight committees. Maybe you head oversight committees, or if you're investment staff, you have. You need to feel comfortable that the number or the allocation that you have to a particular portfolio is indeed what you're willing to live with. And until you get comfortable, you start small, and then you grow big. And then again, I think I've been taking too much time. So what I'll do is I'll run very quickly. I don't want to spend too much time on the subsector part of allocation. That is how much for hedge funds, real estate, and private equity, and maybe we'll take that up separately. But the one thing which is, I think, very important is when we are looking at hedge funds. In fact, you talk to people, and most people believe it's the greatest thing since sliced bread. You get great returns, low volatility, and it's great. It's fun. You can put 100% in hedge funds if that were indeed the case. Unfortunately, that's not the case. The problem with hedge funds is more specifically, and I'll restrict most of my remarks to hedge funds, moving away from the alternatives as a class in general, because I think that's what I've been told is what we'll focus on this morning. You want to restrict the high losses. There's always the probability of very high losses, and the trick is make sure you don't get into that situation. If you can avoid the large losses, I think hedge funds is a great business. But the trick is, how do you make sure you don't get those large losses? And that's the problem. The hedge funds, why does everybody like hedge funds so much? One, of course, as I said, no risk, no this thing. The other reason why people like hedge funds is they say it's totally uncorrelated to the rest of the markets. And I don't know how many of you believe that. I used to believe in tooth fairies, as they say, but I stopped believing in that. When as somebody once said, when markets are going down, the only thing that's going up is correlation, and which is true. We believe that, and to follow that up, the only perfect hedge is in a Japanese garden. So I believe both of those statements absolutely. So it's a great asset class. I mean, don't get me wrong. I myself, I work in a group which does hedge funds, and I've worked with hedge funds for many years. But it's very important that we get into this asset class with our eyes open, and that's basically the message that I'd like to leave you with. Let me tell you very quickly. Steve, how much time do I have? 2 minutes. I've been taking much longer than I should. Okay. See, that's the thing. I've been having fun, and that's not a good thing. So I can keep you here forever. Okay.
No, you can't.
No, I can't. Okay. I think that's a good point. Okay, that's an excellent point. Okay. The first thing is, when we started getting into this for the World Bank, we had an oversight committee, and the oversight committee would say, do you really want to get into hedge funds? Isn't that a very risky kind of business? And do you remember LTCM and all that sort of stuff? And the point that we had to make was, let's be very clear. You need to get into hedge funds with risk management, but risk management does not mean avoidance of risk. There's a fundamental difference. You have to take risk, but you have to take it and manage that risk, and that's really the message. And how did we do management of risk? We basically did it in 2 ways. First, you want to make sure that you have a group together who really understand, when they invest in a strategy, what is likely to be the risk associated with that strategy, and construct a portfolio so that it is not just managers. You don't look just at Sharpe ratios of a manager and say, this manager has a great Sharpe ratio, so let me invest in so-and-so and not invest with so-and-so. It is understanding under what circumstances a hedge fund manager will make money. It is putting together a portfolio so that the final outcome of that portfolio, just like in portfolio theory, is going to give you the risk and returns that you are really interested in. It is not just whoever will give me the best Sharpe ratio, because a portfolio of that nature, you will find eventually could lead you to situations in which when there is a market shock or a crisis of some sort, the returns that you are likely to realize are things which you just don't like. So we try to make very sure that that we understood what was going, and then so on the one hand, get into a manager, know what the manager is doing. And here I'm going very quickly, but we can take some of that in a Q&A at a later point in time. But the second aspect of it is making sure there is transparency on an ongoing basis. Make sure that the manager is doing what the manager has told you what they're supposed to do. It is important to know as an investor, it was very important for me to know what I was doing, but it was even more important for me to know what our managers were doing. And so the risk monitoring part of it is very important. And this is a very emotional issue. You talk to investors, they'll say, we will never get into a fund because hedge funds are these black boxes, no transparency, we don't know what the hell is going on. And on the other hand, you talk to hedge fund managers and they'll say, this is proprietary, we are doing the best for our clients, we don't want to give out information which will in any way compromise the returns, and obviously this is intellectual property, blah, blah, blah. And so there always has to be a balance between the two. And the way we approached it was using third-party risk service providers, parties to whom information gets channeled in from the hedge funds, which we then use for doing stress tests and various other kinds of risk management things. Okay. It's important to have people who talk to hedge fund managers and understand what is going on. It is equally important to get reports on an ongoing basis. But then when you get those reports, it's not just to be shelved. It is reports that has to be seen and acted on. And not too many people, they get the reports and then they don't know what to do with the reports. So you need three steps of the process. People who put together a portfolio which is good, you put together a monitoring system which gives you the information, and then you have to have a mechanism which will act on that information. And you see, if you don't act on the information and act on it too late, it's a little bit like bolting the barn door after the horse is bolted. Finally, what do I want to leave you with? Just three messages. Hedge funds are attractive, and because I'm getting kicked under the table, no, I'm not. Hedge funds are an attractive asset class. As investors, you would do well investing in hedge funds, and that's a pitch for the organization I belong to. And finally, take care of the downside risk, and the returns will take care of themselves. Thank you.
Thank you, Sudhir. I didn't realize when we were preparing for the panel that I was going to experience fat tail risk with Sudhir's speech. I think a couple of aspects that you'll hear consistently from Sudhir, from me, and from Andrew is this understanding of what is the aspect of risk, of return that the hedge fund is taking, and so how are we generating the profits? What's creating the profit? Because the thing that creates the profit is the thing that creates the risk. And I think I've heard Andrew's presentation on capital decimation partners. It'll be a recurring theme you hear about understanding the risk that's being taken and understanding the risk that's generating the return. I'd like to then drop down a level in granularity, but shorten in time. I'd like to cover best practices in three important areas from what I would call enterprise risk management, using our Paloma model as to give you some example as Paloma as a business model. Very briefly, we have about 30 different portfolios, different mandates, different risk portfolios that we have at Paloma, and within those 30 different portfolios, we have complete transparency in my group to the positions. We have an enterprise-wide risk system that brings together all the positions. And as I'll talk about this, I think the things that, from looking at a risk management function, three things that I would ask questions about understanding how well does that risk management function work. What is the structure and the process of measuring risk that firm uses? How do they actually measure the risk? What is the capital allocation process they use? And how do they communicate risk to investors? The three areas that I like to focus on and cover, and then hopefully by covering those areas, hopefully I'll give you the detail that you can use to ask questions if you're thinking of making an investment in hedge funds. In understanding the process of risk management, I think very often when people think about risk management, a risk manager will come across with we have a black box, this big computer with lots of formulas, and out comes an answer of this is a good risk or this is a bad risk. And it's very much this, what I would call perception versus reality. That's not how I would feel comfortable about making an investment in a hedge fund. The time that I make that investment, when someone says this is a black box and it is absolutely going to give me the answer, is the time that I start to worry about what is missing, because the real reality of risk management is that in dealing with a large fund, a large set of positions, there's the grimy reality of data quality, of understanding, and of in essence, over-reliance on a model. So it's much more about the process of managing risk day in and day out, rather than over-reliance on a single model or a single approach to the measurement of risk. So single measurement, mean variance, no. Some of the things that Sudhir talked about, which were more than going beyond mean variances as a means of measuring risk. Scenario analysis, stress testing, and the entire process. And I'll cover some of those in a little bit more detail. But the question I would ask is, does the manager have a repeatable process that works 365 days a year and is not really dependent upon one individual's judgment call? Is it a process which manages the risk by process? A question to ask, where is risk management in this organization? What is its role? Is it positioned, I use the phrase of tailpipe positioning. Does that mean that everything happens, all the decisions are made, and at the end, someone takes all decisions and looks at them and says, is this a good portfolio or a bad portfolio? That's not the risk management process that I would advocate. I would advocate an integrated risk management process where risk management is participating in the decisioning and advising on the decisioning along the way. It speaks to where is risk management in the new manager or the new portfolio selection process. How is risk being assessed at that initial point in time when you're deciding to make, when we decide to make an investment either in a new manager or to add capital to an existing manager? A little bit of an overview of a process that we use is that whether it's a new manager or the process with the 30 portfolios that we have, is at the outset of the year, we look at what the expected return is going to be on that portfolio. We then set up a budgeted risk capital, an amount of capital that we think is going to be needed to support that, and I'll talk a little bit in a little while about how we set that risk capital, what that means. And then, in essence, through the year, we actually will look at performance results, not just on performance versus the actual capital committed, but we'll actually look at performance enable us to look at opportunity versus capital committed. So we thought that this particular strategy was going to have a certain opportunity in the marketplace. That was what our original portfolio estimate and our budgeted risk capital was about. And now we're going to look at the actual risk capital committed during the year. So we look at variances from performance from two different points of view, both from what was the variance in the opportunity in the marketplace, as well as the variance that occurred because of either the risk performance did not work out the way it was intended to. That then puts risk management in a place where it's really an integral part of the performance measurement process, working hand in hand with the finance organization, with operations, risk management operations, understanding the data issues that are necessary. Do we have the right volatilities? Do we have the right credit spreads if we're a credit-sensitive activity? And so rather than thinking about risk management as a unit, it's risk management as a parallel process in each of the things that occurs from the initial hiring through the capital commitment right through to the settlement of the transaction, that there's an interaction between the risk management group and each of the groups within the firm along the process. So I talked a little bit about, and I mentioned budgeted capital and actual capital, and there's lots of definitions of capital, and let me just, for good order's sake, put out two definitions. Economic capital, the amount of money that the investors have given us. Very straightforward. Risk capital, an amount of money that we think should be set aside to cover potential losses in a portfolio over some period of time. Now, what is the difference between those? To give you an example, if we think that a particular portfolio will have what we call is an estimated market risk, and I'll tell you a little bit about how we think about estimated market risk. Estimated market risk over a 1-month horizon of $5 million. That means at some confidence level, at some degree of estimation, we think that the worst loss that this portfolio could have over a 1-month time horizon is $5 million. If at the same time we want to have an assumption that we don't want to have any one portfolio have more than a 5% drawdown in a month, or 3% drawdown, you set the number on that. And that's an important distinction to set, is that drawdown amount that you want to have, because that'll give you your idea of how much cash buffer you need to have against the risk. If you set that at 5% and the portfolio has a $5 million estimated market risk, you then therefore have a risk capital amount of $100 million, an amount of theoretical money that you need to set aside so that if you lose $5 million, you will have not exceeded your 5% drawdown. We then think about that risk capital on both, in essence, a budgeted point of view and an actual point of view. One of the interesting differences in how our fund works is that within the 30 portfolios, we do not have static capital allocation. We do not say to a given portfolio manager, here's $30, $40, $100 million. That is the amount you must invest during the year. Instead, our capital allocation is dynamic based on the amount of opportunity in the marketplace. So that, in essence, we set out a budgeted risk capital at the beginning of the year, but if in the middle of the year the manager says, it gives him the flexibility not to be forced to take risk because he has a fixed capital. He's able to, in essence, return that capital to us, and we can then diversify it across the other portfolios. We, in essence, take the risk of uninvested capital. We look at that and able to move capital from one place to another based on the opportunity in the marketplace. We evaluate the manager based on his return on actual capital employed. How do we take that then into performance measurement? We then look at that, as I said, as a return on that risk capital, and we look at that return at the different levels of portfolio. The estimated market risk that I talked about, in essence, and that is an important aspect of asking a question about how does the fund measure the risk. Many people have talked about value at risk and have criticized value at risk, and intentionally we do not call the amount of estimation of risk over the time horizon value at risk per se. This very much comes down to understanding the risk that the fund is taking, the risk that the manager is taking, and what can go wrong in that strategy. So let me use risk arbitrage as an example. If you have a manager that's in risk arbitrage, and that manager says, well, I use value at risk to measure the risk of this portfolio, well, it seems obvious that what that's going to do is understate the amount of risk in that particular strategy. Why? Because at the point in time when the deal is announced and you enter the deal at that point in time, you have a pattern of trading that will suddenly those two stocks will move in tandem, or there'll be a spread. Certainly there'll be spread widening or contraction between the stocks. But value at risk then, in essence, automatically says that because they are moving in tandem, their correlation is much closer, and so therefore the risk is lower of being in that transaction. But what is the risk arbitrageur trying to do? He's basically taking the risk that the spread will close, but he's taking the profit opportunity that the spread will close. But the risk is that the deal breaks and the two stocks correlation goes away back to where it was. So in our view, when we think about something like estimated market risk over a month, we would use a process that would say, let's look at the risk over that 1 month time horizon under the assumption that the deal broke, return to some pre-deal announcement level, and we then capture that gap risk. That's just one simple example of how, when you think about the risk in a portfolio, that you have to tailor the risk measurement process to the risk being taken. If a trader is short volatility or short options, as Capital Decimation Partners will be, very much so, a variance approach will then understate the risk, and then when the event happens that the situation blows out, the risk will be much larger than the risk assessment. And just one other point to make about risk measurement is that the interaction and this integration of risk management with the rest of the organization, that it's very important to have integration between the measurement process and the P&L process, and a comparison and a verification of one to the other. The daily profit and loss is a real live realization of your value at risk or your estimation of market risk. If you thought that your risk with a one standard deviation in the market would be $2, and you get a one standard deviation move in the market the next day, you should have a P&L of $2. If you don't, if those three things don't triangulate, there was either something wrong in your P&L, something wrong in your risk assessment, or you have bad market data. I would tell you that usually it's not the market data that's wrong. That's actually usually pretty good, and usually it's either the risk assessment or the marking of the positions. And that's an important little comment there. The marking of the positions, that's one of the ways that this problem of marking to market of positions should be checked. That's one of those little questions that you can ask when making an investment in a hedge fund as to the risk management process. What is the interaction between risk management and the marking of the positions? And we certainly know about a hedge fund that didn't necessarily have that connection between the marking of the positions and ended up having quite a large problem. So in understanding our estimated market risk, it's very much oriented towards, we have to understand that the trader is taking some sliver of risk and thinking about how can I profit from that sliver of risk. And I'll give you one last example on risk measurement, is that I had a trader in one of my other positions come to me and say, here's how I think we should measure our risk. And he came up with a very complex factor model that analyzed 95% of the risk in this particular it was a corporate bond kind of portfolio. And I was like, that's very good. That is a good way. And he says, isn't that good? We're measuring 95% of the risk of this position. That's pretty good as far as models go. Allocation and zero risk assessment in that strategy. The thing I always try to avoid is I don't like to be arbitraged as a risk manager. And so therefore risk management arbitrage and understanding the risk and the reward is very much the point here of understanding and asking the questions. And it's part of your due diligence process. Does the risk manager at an organization, does the organization have a risk manager? Does it have a risk management process? Does it really understand the risks that the traders are taking and how they profit? And lastly, I'll speak a little bit about transparency and communication with investors. And it's a point that I think is very, very important, because good communication for us to our investors means something very important to us. If we don't have good communication of the risk that we're taking, and you notice I said communication of risk and not necessarily transparency, communication of risk, then the investor doesn't understand the amount of risk that's being taken. When an investor doesn't understand the amount of risk being taken, in all likelihood, he's going to want more of a cash buffer against the risk. He's going to look towards lower leverage or lower risk factors in understanding the risk of investing in that fund. Now, is that efficient from an investing point of view? We don't think so. We think that it'd be better if the investor understood the risk and we weren't having, in essence, an over cash position because of a lack of communication.